So clients often ask what the difference is between a pooled product and a private client investment. So today we're going to talk through the differences between the two. In simple terms, a pooled product or a collective investment fund, or a unit trust fund as it's known in the old days, is basically a fund that houses a range of different instruments, and all the investors that invest into that fund have the same exposure. So all investments look the same, all investors get treated the same, and there's no distinction from one investor to another one. So when managing a private client portfolio, we look at each client and the individual circumstances and the individual needs. Each client's got a different investment objective, and we need to take that into consideration when we build the portfolio. What we do is we take a combination of different asset classes, which basically comprise of shares, or generally known as equities. We looked at fixed income, which will be your bond investments. So that could be government bonds, that could be corporate bonds. And we look at a range of different other investment instruments like money market funds, and we do the same between local and offshore. So when we build a private client portfolio, we need to look at each client and their individual circumstances, and we need to take the investment objectives into consideration. Each client, as we know, has got a different investment objective. So what we do in a private client portfolio, each client holds their own assets in their own name. That means we buy the underlying securities, whether they be shares, whether it be bonds, funds, and we blend those into an investment portfolio to suit that individual client's needs. So each one of our clients, although we've got a central investment process to make sure that we get the best investment outcome for clients, we can custom make that portfolio to suit the individual client's needs.